All right. Hey, it's Jack from Jack Gately Real Estate and the Online Real Estate Academy. We have just had the Atlanta Fed president, Bostic, come out and said that he's only expecting one rate cut this year. And that rate cut would come in Q4, effectively after the election. I know that is like, remember, it was only a couple months ago, 4 or 5 months ago, where people were like 6 rate cuts in 2024. Remember that? Yeah, that's not going to happen. Not going to be 6 rate cuts. And now Bostic is saying 1 rate cut. This is just breaking news today. Atlanta Fed President Bostic sees only 1 rate cut this year occurring in the fourth quarter. There's a lot of Fed talk this week, including I think we have Powell tomorrow. And when you look at the Fed rate tool, we are now looking at a 2.4% chance of a rate cut for the May 1st meeting. So there's basically almost a whole month before that meeting happens. May 1st, 2.4% chance of a cut. You will notice a trend. Is that they constantly, you've heard me say this before, moving the goalposts. Oh, it's not going to be this month, but it will definitely be the next meeting. So if you look at the next meeting, which is June 12th, the results are mixed, with 57% of people thinking there's going to be a rate cut. But that number, I guarantee you, when we get closer to late May or early June, it's going to look like this again, right? It's going to look like that because the thing just keeps on shifting. The expectations keep on shifting. Why is that? And we're going to talk about that in today's video. It has a lot to do with our government spending and the jobs market. But look what happened to the bond market based upon Bostic's statement today. We are now above 4.4 and heading higher on the bond market. Now, again, if you're a real estate agent, why does the bond market affect you? Because 30-year mortgage, which is the most common mortgage in the real estate business, flows from the bond market, generally speaking. And when we see it this is a recent high at 4.4, that is alarming because interest rates could go up from here. So on any given day, the bond market determines the interest rate. So if you're not sure what the interest rates are going to be, you could always head over to Mortgage News Daily, and they will tell you right on their homepage, Mortgage News Daily, they will tell you there's a nice little chart they got over there. And yesterday, the 30-year fixed closed at 7.06, and they usually have a write-up or two about what happened in the bond market. That's very exciting. Or you could head over to Lance Lambert's Twitter page, and he almost always posts a picture of the Mortgage News Daily website, and he actually covers the spread for you or calculates the spread. Jack, what's the spread? The spread is the number of basis points between the 10-year note and the quoted 30-year fixed at the end of the day. And this had been into the 310 basis point range several months ago, but it's now started to shrink a little bit, which has meant that as the bond has gone up, we haven't seen as much of a correlation in the increase of mortgage rates, because as the rates have gone up, the spread has gone down, so it's offset that a little bit. And right now we're looking at a spread of somewhere in the low 270, 271 here. It's been fluctuating in the low 270s for a little while. So you could see a situation where the bond goes up, and that's tempered a little bit by the fact that the spread might go down. And I think we have a lot more to go on the spread. That spread is, I think, historically more like 200 basis points. So we could move a little bit further lower on that spread, and that would be less pain for the mortgage rates. But right now, we are looking at mortgage rates that are now again above 7%. We had dipped a little bit down to 6.9, and now we're back up over 7%. And when you see the 10-year at 4.4, headed into the all-important jobs number, which is going to be Friday, right? Non-farm payrolls come out on Friday, and there's now a lot of criticism of whether or not these payroll numbers from the government are actually what they're all cracked up to be, and we're going to talk about that in today's video. By the way, while we're talking about Lance Lambert at Resi Club, my favorite new website, a big shout out to Michael Zuber over at One Rental at a Time. He is just launched in coordination with the Resi Club. This is not sponsored, although it should be. The Zuber letter. Congratulations, Michael Zuber. You are now part of the Resi Club Network, whatever that is. The Zuber letter will be part of the Resi Club Network. Go check out Lance Lambert's tweet on that. And I subscribe to the Zuber letter. It was free, and you should too. You should too. Congratulations, Mr. Zuber. Great job on that. So why are our rates going up? Why are bond yields going up? And it's just undeniable that Washington is completely out of control with our spending. Here's my second favorite economist, E.J. Antoni, talking about our federal debt. It explodes to $41 billion higher yesterday, now reaching $34.6 trillion for the first time ever. We're on our way to borrow $2.9 trillion with a T this fiscal year. How long before bond vigilantes have to remind everyone how much power they have? In other words, our spending is out of control, and when we're spending out of control, we're flirting with a death spiral of debt. Almost all of our spending, what are we at? 67% of our spending is so-called mandatory autopilot spending. In other words, Congress doesn't want to do its job. We are now spending so much money that we're basically taking in half of what we spend on any given year. So let's talk a little bit about what that brings for the economy. Here is E.J. Antoni on CNBC, or Fox Business, I should say, with Stewart.
Please explain to me how, if we have the best economy in the world, why is Russia growing faster than we are? Why do we have many of our friends and allies around the world with lower inflation rates than we have here at home? If things are so good, then why is it that the American people are getting 2 or 3 jobs just to make ends meet? By the way,
that's very important. So a lot of these jobs numbers that you are seeing out there, where like the ADP number or any of the government numbers, they're reflecting job units created. But if you're continually creating McJobs or DoorDash jobs and not real 40-hour jobs, you see the job numbers go up, but that's just the headline number, and it doesn't actually reflect reality on the ground of people trying to get by with 2 or 3 DoorDash jobs, so to speak. Back to EJ.
That's doing wonders for your payroll figures, because every time a person goes out and gets a second or third job, it's increasing that headline number without actually increasing the number of people employed.
It increases the headline number without actually increasing the number of people employed. And again, this is on the heels of our jobs numbers that are due on Friday. But with the Bureau of Labor Statistics coming out with the non-farm payroll on Friday, we have my favorite economist, Professor Pete, to describe how those numbers are cooked.
Philly Fed just admitted that the payroll numbers are cooked to the tune of 800,000 jobs that are not real. The first warnings came last year when the Philly Fed's quarterly census of employment and wages found that instead of the 1.1 million jobs reported by Joe Biden's BLS, the actual number was 10,000. So that is an astounding miss. It's a 110-fold miss.
110-fold miss. It's hard to believe. I don't want you to shake your confidence in the federal government, but he's basically saying that the Federal Reserve, the Philly Fed, found that the Bureau of Labor Statistics was off by a factor of 110, and that the jobs that we're seeing creating are really not there. And I think if you talk to people in the real economy, if you talk to real people, they're very concerned. I know a lot of people that have a new job, but it's also a job on top of a job. And maybe you know those people too. It is not a great time in the economy. There's no way you can spin that this is a great economy. Here's EJ and Tony once again ahead of Friday's job data, adjusted the household survey to more closely resemble the methodology by the establishment survey, shows employment dropping fast at a recession pace. So when we look at the objective of the Fed, the objective of the Fed is to have a soft landing. That would be low interest rates and a fairly healthy growth in the economy. What I'm continually being concerned about, and I think you should too, is higher interest rates. And I think when we see these bond numbers go up, what we are seeing here is an understanding that we are here for higher and much longer. Not just higher and longer, but higher and much longer when it comes to interest rates. And while we might see some movement on like the 2-year, if we get a Federal Reserve cut of interest rates, that's probably not going to move the 10-year all that much, because the long-term fiscal health of the country, like when you see on this chart here relative to our debt, when you look at this chart, it is undeniable that the long-term federal health of the country, financial health of the country, isn't looking too good. So on this chart, that means that we might have higher inflation for a much longer time and meager job growth, actual real life job growth. So I think we're going to be actually headed towards the worst possible situation. I am not optimistic about the current economic situation. The worst possible situation, which is meager job growth and higher inflation for much longer. That's known as stagflation. And I think the only question is how bad will the actual stagflation be? How bad will the actual stagflation be? And if we are real estate agents, which most of my viewership is, you need to be able to explain interest rates and where interest rates are going, and also where the real estate market is going, because those things obviously go hand in hand. I was watching CNBC yesterday, and I found two experts. I was just eating lunch and threw it on the TV, and the first expert came up and she was asked, "What's going on with Bitcoin? What's your expectation for Bitcoin as a proxy for the overall economy?" And she said, "Well, it could go on 100,000 or it could go to 20." And then she said something which shocked me. "I just don't know." So that was like a moment of honesty on CNBC that you usually don't hear. And I was like, what? And then the next guest up was asked effectively the same question: "What's your outlook for the economy?" And he said, "Well, there's so many different data points. A lot of them are conflicting. I don't know where the economy is going," the guy said. Now I really stopped eating lunch and I looked up and I said, wow, two experts in a row both said they don't know. And I think part of the confusion is understanding the role of the Federal Reserve in the electoral cycle. Of course, they're not political in any way, shape, or form. But I've said this before, and you've heard me say it before. The role of the Fed in an election year, a presidential year, and this is not a partisan comment, this doesn't matter who the president is, but the role of the Fed in an election year is to reelect the incumbent, no matter who they are. This is not a Democrat or Republican thing. That's the role of the Fed, no matter who the incumbent is. And I can totally see how the Fed, along with the Biden administration, is going to do everything they can to kind of keep this Humpty Dumpty together until right after the election. And that's when the eggs splatter. That's when it hits the fan, right? And that's when we get the worst of both situations: much higher interest and a faltering DoorDash economy. That's not a soft landing, but a double hard. Well, it's a family show. I can't use the word, but it's a double hard Yeah, exactly. That's exactly what it is. You know what I'm saying. So, and I think that'll be just after the election. So as we go into the spring market, which is now upon us, and I'm really happy to say I've got a couple of listing appointments lined up in the next couple of days. As we go into the spring market, right now you have to be mindful that interest rates are starting to creep higher. And they are probably going to creep even higher long term. I'm not saying that we won't have a couple of dips and valleys along the way, but in the long term, interest rates are going to be higher. I think that's what you should be advising your clients. Remember, I'm no economist. I'm no lawyer. Way too smart to go to law school. But that's what we're looking at. That is the real life expectation of what we're looking at, unless somehow the federal government can turn the spending spigot off, which it doesn't seem that they're inclined to do. All right. Hey, it's been great to be with you. I will be out on Thursday and Friday, so I will not be with you for the non-farm payroll on Friday, but I hope to be back on Saturday. Once again, congratulations to Mr. Zuber and his partnership with Resi Club. Way to go. Nice job. Congratulations on that. In the meantime, have a great week. Go make some money. Bye-bye.